As of 11:45 a.m. ET on Tuesday, May 12, 2026, Opendoor Technologies is trading at $4.85, marking a downward slip of 3.19% so far in the session. While the headline number shows a stock struggling to find its footing after a volatile morning that saw it dip as low as $4.71, the underlying reality is far more interesting than a simple red candle on a screen. Most investors look at a 3% drop and assume the company is failing to meet the moment, but the deeper data reveals a massive divergence between institutional positioning and retail sentiment. While short-term traders are reacting to the broader market sell-off triggered by soaring oil prices and geopolitical tension, the smart money is quietly eyeing the fact that Opendoor just reported its best home acquisition contract quarter since 2022. This is the classic expectation versus reality trap. The expectation is that high mortgage rates and a sluggish housing market will starve the iBuying model of oxygen. The reality, however, is that Opendoor is currently processing over 5,000 home contracts in a single quarter, which is double what they managed just a few months ago. We are seeing a company that has fundamentally rebuilt its engine while the car was still moving at 60 miles per hour, and the market hasn't quite decided if it believes the new mechanics. The common belief right now is that real estate services are a dead end until the Fed aggressively cuts rates. You hear it on every financial news cycle and see it reflected in the cautious hold ratings from firms like Morgan Stanley. But if you look closer at the intraday activity on platforms like the Robinhood app or the Fidelity mobile app, you see a tug of war. There is a specific tension between the expectation of a continued housing freeze and the reality of Opendoor's 2.0 operational model. This new model is designed to be lean, using AI-driven pricing that is finally starting to show margin stability. In fact, the company recently noted that their late 2025 and early 2026 home cohorts are performing with better resale velocity than almost anything we have seen since the 2020 boom. This is the contrarian take that most people are missing. While the stock price is being dragged down today by a broader Nasdaq retreat, Opendoor is actually proving that it can buy and sell homes profitably in a high interest rate environment. It is a high-stakes experiment in data science versus old-school real estate, and right now, the data is starting to win. If you are looking for investment help or exploring self-investing options through Interactive Brokers trading, you have to look at the volume. Today's volume is tracking right along its 90-day average of about 40 million shares, suggesting that this isn't a panic dump. Instead, it's a consolidation. The stock has been a favorite for those who engage in online investing because of its high volatility, which makes it perfect for individual brokerage accounts and active trading platforms like the SoFi trading platform. But for the long-term holder, the question is about the path to break even. Management is signaling that they expect to hit adjusted EBITDA break even by the next quarter. That is a massive claim for a company that was losing hundreds of millions of dollars just a couple of years ago. The expectation is that they will miss that target because of the macro environment. The reality is that their contribution margins have been climbing every single month since last September. When expectations are this low, even a moderate success can feel like a massive win for the stock price. Looking at the broader landscape of online investment, we see that Opendoor is often lumped in with high beta tech stocks like Nvidia stock or Tesla stock. While it shares the volatility of those names, its fundamentals are tied to the dirt and bricks of the American suburbs. This creates a unique dynamic where the stock can trade like a tech company one day and a REIT the next. Recent institutional activity shows that firms like BlackRock and Vanguard still hold significant positions, representing over 20% of the float through various Fidelity ETFs and mutual funds. This institutional backbone provides a floor that many retail investors don't account for when they see the price dip below $5. They see a penny stock risk, the institutions see a market share grab in the making. If Opendoor can maintain its current trajectory of doubling its acquisition volume without blowing out its balance sheet, the narrative will shift from survival to dominance. Comment below how many shares of Opendoor you currently hold, or if you're waiting for it to drop back toward the 52-week low before buying. Your participation helps us gauge the true sentiment of the retail community versus the institutional narrative. To understand where we are going, we have to look at what Opendoor actually is today. Its business model is built on the concept of liquidity. They provide a guaranteed exit for homeowners who don't want to deal with the months of uncertainty, staging, and open houses that define traditional real estate. They make money on the spread, the fee they charge for the convenience, and the difference between what they buy the house for and what they sell it for. In the past, they were criticized for overpaying and then getting stuck with inventory when prices leveled off. But the Opendoor 2.0 strategy is much more clinical. They have narrowed their focus, improved their spreads, and cleared out the legacy inventory that was weighing down the balance sheet. This shift is why you see so much interest in the stock on investing sites, and why it remains a top search ticker on the SoFi Invest and Fidelity Wealth Management platforms. The company is no longer just trying to grow at all costs, they are trying to grow at the right cost. Recent earnings reactions tell a story of a market that is looking for any excuse to be bullish, but remains haunted by the past. When they reported Q1 results last week, the loss was wider than some expected, 0.18 cents per share versus the 0.1 cents consensus. Usually, that would lead to a 10% or 20% crash. Instead, the stock actually edged up in the following sessions. Why? Because the revenue beat and the forward guidance on home acquisitions were so strong that they overshadowed the net loss. Investors are finally starting to look past the bottom line and into the operational metrics. They are seeing that the company has nearly $1 billion in unrestricted cash. That is a significant war chest that allows them to navigate this period of high mortgage rates without the immediate fear of bankruptcy that plagued the sector in 2023. Macroeconomic pressures are the biggest reality check for this stock right now. We are currently seeing crude oil prices sit above $100 a barrel, which fuels inflation fears and keeps the pressure on the Federal Reserve to keep rates higher for longer. This is toxic for the housing market because it keeps buyers on the sidelines. However, this is where the tension creates opportunity. If everyone expects the housing market to stay frozen, and Opendoor proves they can still move 5,000 homes a quarter in that deep freeze, what happens when the market eventually thaws? The upside potential is what keeps the stock active on the Robinhood app and keeps it as a frequent topic for those seeking investment help. The reality of their $3.9 billion in trailing 12-month revenue shows that this isn't a small-scale operation. They are a massive player that has been humbled and is now being rebuilt with much tighter discipline. Looking ahead, the catalysts are clear. We need to see that Q2 adjusted EBITDA break-even actually happen. If they hit that mark, it validates the entire 2.0 strategy and could lead to a massive re-rating of the stock. Currently, the stock trades at a price-to-sales ratio that is significantly lower than its peers in the real estate services sector. While companies like Compass or Zillow have their own strengths, Opendoor is the only one taking the full principal risk of the home, which gives them the highest upside if their pricing algorithms are correct. The risks, of course, are just as real. If we see another spike in inflation or if the employment market starts to crack, the housing market could go from slow to broken, and no amount of AI-driven pricing can fix a lack of buyers. The institutional sentiment is beginning to lean towards a wait-and-see approach, but the retail side is increasingly aggressive. On platforms like SoFi Active Investing, we see a lot of interest in fractional shares open, as the low nominal price makes it an easy entry point for new investors. But you have to be careful not to mistake a low price for a cheap stock. Valuation in this space is about the velocity of capital. How fast can they turn a house? Right now, that velocity is increasing. They are selling homes faster than they have in years, which reduces their exposure to price drops while the home is on their books. This efficiency is the hidden reality that the market is slowly starting to price in. In the final analysis, the tension between the expectation of a housing collapse and the reality of Opendoor's operational turnaround is what makes this stock one of the most compelling stories in the current market. We started today with a price of $4.85, a reflection of the broader market's nervousness and the geopolitical shadow hanging over the global economy. But when you peel back the layers, you find a company that is leaner, smarter, and more focused than it has ever been. They have navigated the worst of the interest rate hikes and come out the other side with $1 billion in cash and a growing list of home acquisition contracts. The old Opendoor was about growth at any cost. The new Opendoor is about survival through precision. Whether you are using Schwab Intelligent Portfolios or managing your own individual brokerage on the Interactive Brokers platform, the data suggests that the worst for Opendoor may be in the rearview mirror. The contrast between the current stock price and the company's operational progress is a gap that will eventually close. The only question is which direction the market chooses when it finally accepts the new reality. Authority in this market comes from recognizing these shifts before they become common knowledge. And right now, the shift in Opendoor's business model is the most important story no one is talking about loudly enough. Maintain your discipline, watch the volume, and stay focused on the path to profitability, because that is where the real value will be found in the coming quarters. This is a game of patience, where the reality of operational excellence will eventually overcome the expectation of macroeconomic failure. Keep a close eye on the daily swings and the institutional flow, as those will be the first signs of a larger trend reversal. For now, we watch the $4.85 level and see how the market handles the rest of this Tuesday session. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, outshare with your friends, bell, subscribe for more updates.